Welcome to our channel. Today we are going to tell you about the best investment opportunities for beginners. The goal of our video is to provide you with the necessary information to start your investment journey. Before we get started, don't forget to subscribe to our channel and click on the bell to get notified of new videos. The first step on your investment journey is to assess your financial goals. What do you want to achieve? It could be increasing your personal budget, building retirement savings, or achieving financial stability. Before you start any investment, it is important to carefully consider and define your financial goals. This means thinking about and defining what you want to achieve through investing in the future. Assessing your financial goals helps you create an investment strategy that meets your needs and expectations. This assessment may include aspects such as target amount. How much money do you need to reach your goal? For example, it could be retirement savings, financing your child's education, buying a home, traveling, etc. Time horizon. How long are you willing to invest in achieving your goal? Is it a short-term goal like buying a car or a long-term goal like retirement savings? Risk level. What level of risk are you willing to accept? Are you more interested in conservative, lower-risk investments, or are you willing to take risks for a possible higher return? Diversification. Do you plan to diversify your investment portfolio by spreading your risk across different assets? Methods of achieving the goal. What specific investment instruments or strategies do you plan to use to achieve your goal? Assessing your financial goals is important because it sets the course for your investment journey. It helps you balance risks and rewards, plan your strategy, and make informed choices about where and how to invest your money to achieve your goal. The world of investments is diverse. We'll look at different types of investments, starting with stocks. Advantages of shares. Investing in them can lead to high profits with successful companies. Shares can be bought and sold quite easily on the stock market. Disadvantages. Stocks can fluctuate and lead to losses. Predicting the behavior of stocks is difficult, sometimes even for experienced investors. Risks. Stocks can fluctuate significantly in value due to economic, political, and other factors. The decisions of the new management of the company may affect its success. If the company you invest in goes bankrupt, you could lose your entire investment. Possible rewards. Companies pay dividends, which can provide a steady income for shareholders. Successful companies can lead to an increase in the value of shares, which allows you to make a profit when you sell them. Bonds. Advantages. Bonds usually provide a steady interest income. They are usually less exposed to market fluctuations than stocks. Disadvantages. Lower potential reward. Compared to stocks, the returns on bonds may be lower. If you sell bonds before maturity, you may experience a loss in value. Risks. If the bond issuer, e.g., a company or government, is unable to pay interest or principal, you could lose money. The value of bonds can fluctuate in the market, affecting their value when they are sold. Possible rewards. Bonds provide a steady interest income over the term. At the end of the bond's term, the principal is returned to the investor. Real estate. Advantages. Renting out real estate can generate stable cash flow. Over time, real estate can increase in value. Disadvantages. Renting real estate requires some effort and management. Selling real estate can be a more difficult and time-consuming process. Risks. The property may remain empty, resulting in a loss of potential income. The value of the property may decrease due to market fluctuations. Possible rewards. Renting out real estate can provide a stable income for the investor. Over time, the value of real estate can increase, providing an opportunity to make a profit when selling. Cryptocurrency. Advantages. Easy to buy. Some cryptocurrencies can provide significant returns. Disadvantages. Cryptocurrencies are known for their volatility and popularity. The cryptocurrency market is not regulated as strictly as traditional financial markets. Risks. Cryptocurrencies are known for sharp fluctuations in value, which leads to high risk. Your digital assets may be exposed to cybercriminals and fraudsters. Possible rewards. Some cryptocurrencies can provide high returns when invested successfully. Cryptocurrencies may be available for global transactions and investments. Investments in education and business. Benefits. Investing in education can lead to improved skills and the possibility of higher income. Investing in a business or startup gives you more control over your investment. Disadvantages. Investing in a business may involve a risk of failure. Investing in education and business can require significant effort and time. Risks. Investments in business may not yield the expected results and may result in financial losses. Investments in education and business require significant time and energy. Possible rewards. Increased skills and knowledge. Investing in education can increase your skills and opportunities to earn higher profits. If the business is successful, you can gain profit and financial stability. Each type of investment has its own risks and possible rewards. Choosing an investment strategy. Assessment of financial goals. Consider your financial goals and time frame for achieving them. Determine whether you are looking for short-term gains or long-term capital growth. Risk tolerance. Consider your risk tolerance. If you are not prepared for large fluctuations in value, you may want to choose less risky investment options. Asset diversity. Different types of assets have different levels of risk and return. Choose an investment strategy that suits your needs and spreads your risk. Investment time frame. Consider your investment horizon, i.e., how long you are willing to hold your investments. A long-term strategy may include more equities, while a short-term strategy may include less risky assets. Knowledge and experience. Beginners are advised to start with investments they understand and expand their experience over time. Portfolio diversification, spreading the risk. Don't put all your eggs in one basket. Distribute your portfolio among different types of assets such as stocks, bonds, real estate, and others. Geographic diversification. Consider investing in different regions and countries. Different markets may react differently to economic changes. Sector diversification. Spread your portfolio across different sectors such as technology, healthcare, finance, etc. This helps reduce risk in case of deterioration in certain sectors. Assortment of instruments. Consider including different investment instruments such as ETFs, mutual funds, stocks, bonds, index funds, etc. in your portfolio. Constant monitoring. Diversification requires constant monitoring and rebalancing to maintain an appropriate balance between assets. You'll need the following tools and resources to be successful in investing. Knowledge. Start with the basics of investing. Learn about different types of assets, stocks, bonds, real estate, etc., and understand the risks and opportunities. Financial plan. Allocate a portion of your income to invest. Create a budget and plan your finances. Portfolio diversity. Distribute your investments among different assets to reduce risks. Research. Research the companies and assets you invest in, as well as the markets in which they are traded. Long-term approach. Plan your investments for the long term, avoiding emotional reactions to short-term fluctuations. Brokerage account. Open an account with a reliable broker to buy and sell assets. Tracking and updates. Follow the development of your portfolio. Review and update your investments as needed. Expert advice. Contact financial advisors or investment professionals for advice and support as needed. Tips from experienced investors. Getting advice from experienced investors can be very helpful for beginners. Here are some tips from experienced investors. Start with education. Education is your best investment. Learn about financial markets, investment instruments, and strategies before you start investing. Constantly evolve. Financial markets are constantly changing. Follow the news and update your knowledge. Diversify your portfolio. Spread the risk by placing your money in different types of assets and different industries. Take a long-term view. Financial markets can fluctuate, but long-term investments usually have a higher potential for income. Cut off emotions. Don't react to market fluctuations emotionally, or make decisions based on analysis and strategy. Stick to the plan. Have a clear investment plan and stick to it even during tough times in the market. Use a professional advisor. Consider consulting a financial advisor or broker. Rebalance your portfolio regularly. Periodically review and rebalance your portfolio to maintain the right balance between assets. Keep an emergency fund. By having money that is not invested in the market, you can cope with unexpected expenses or negative market fluctuations. Strengthen your children's financial literacy. Investing in your children's education and teaching them financial literacy is an important part of family finance. Stay cautious. Remember that investments involve risks. Do not invest money that you are not prepared to lose. We hope this video has helped you better understand investments and prepared you for successful investing. Remember that investing is a process that takes time and self-discipline. Don't forget to subscribe to our channel and share this video with others who are also interested in investing. Thank you for watching.